Good morning, everyone. I like these kind of good mornings, a little late in the day. But we promise that we will make up for that with some speedy and heady discussion on the topic that's been given to us. Essentially, what is the report card of Indian PE? However, before delving into specifics, I have thought that reiterating a short summary of a report that VC Edge has come out and which is with us today in our packs. Just reading out a few summary items would set the stage for taking the discussion further. So, and I'm quoting now, private equity investments, excluding real estate investments, increased 8% calendar year 2014 over calendar year 2013. The aggregate is now 11.16 billion with a total of 766 deals. In 2013, dropping a little bit to 743 deals in 2014. The average deal value, 19.5 million, but the median showing that the greatest amount of capital being deployed today is on the venture side is only 3 million. Now, private equity deals under 50 million account for 70% of the market, and big ticket deals provide bulk of the capital, which is 100 million plus deal account for about 49% of total private equity capital. There were 33 India dedicated funds launched last year, and they were targeting an aggregate commitment of 4.8 billion. And the figure represents an increase of 14% over the previous year. The good news is that 39 of them managed to mop off 3.85 billion in capital commitments, highlighting the continued interest in Indian private equity as an asset class. Finally, private equity investors liquidated investments to the tune of 3.59 billion across 187 deals during the year. So that is the data. And now let me jump straight into what the LPs on this panel see as India's private equity performance. What is our report card? Let me begin with Jane on this one. Jane, you are allocating capital from a global perspective, and so you would be seeing many other similar markets and a lot of differences that occur specific to India. Keeping that in mind, how do you see what has been the performance of Indian private equity so far?
Thank you very much. Maybe what I could do is just start with a little bit of overview of Ontario Teachers, just to kind of help you understand how we think about the world and asset allocation. Our pension plan is approximately $150 billion. Within that 150 billion, approximately 20 billion or so is in private equity and long-term equities, which is the group that I head up. And then when we think about that $20 billion, perhaps about a third of that is invested in private equity funds around the globe. And there are about 30 core funds that we work with. And of those funds, we're probably more heavily weighted to distant geographies and emerging markets than we are to our home prominent markets. And then when we think about the capital that's not in the funds, so the other 13 or 14 billion dollars, that's where we are investing directly into portfolio companies, and the heavy weighting on that is in developed markets. So when we now think about India, and recognizing that Ontario Teachers is based in Ontario, we also have offices in London, New York, and Hong Kong, we really think about India as being part of our emerging markets portfolio. And to be very clear on that, that's about 15% of the $20 billion that we have at work. And when we think about emerging markets, thematically for us, it's very heavily weighted on finding the right GPs to work with in those markets. And, you know, for folks in the room, Kedaara happens to be one of the funds that we have backed here in India. And We really think about our fund exposures and the funds that we work with as being an extension of Ontario teachers, as being our true partners in the region. And, we come to countries like India in order to become more educated about the market, and we think about markets in sort of over a couple of decades. So we've been doing private equity for over 20 years. I will do a shout out for the team that I work with, because our net performance at Ontario Teachers over 23 years, net of all fees paid, has been approximately 19.75%. So almost 20% net of all fees. So I think my team has done a pretty wonderful job over the past couple of decades. And so it's an honor to lead them. And so all this, a lot of words to say, focusing on finding the right partners to put our capital at work, they're an extension of us, is very important. And these are not decisions that take place quickly. We work with potential partners over extended periods of time. We investigate their track records. We think about how they approach investing. We do reference checks. We do deep dives into the country, and all emerging markets at Ontario Teachers are structured across a tiering system, which, depending on where your country fits within that tiering system, if you will, gives us delegated authority for certain amounts within those markets. So if it's seen as a pretty strong performing emerging market, it gets a high threshold, and we're able to deploy capital within our own adjudication groups. If it is seen as a riskier market, we're allocated less capital, and we have to go through different approval processes. India is right in the main buckets of how we think about that. So long term, we're excited about GDP growth. We are very intrigued by the change in government that has taken place about 9 months ago, though we committed to India before then. But we're optimistic that the momentum is going in the right direction for the next couple of decades as we think about India and working with our partners here in the country. So that's a sort of a global overview. Akhil, I hope that helps set the scene a little bit. Thank you.
So just a quick rebound. You said 20% approximately is the net return that has been generated. What would your expectations be for an emerging market like India? Would it be for how much premium do you think you would like?
Right. Very interesting question. So I'll be quite frank. Our track record in India, if we can separate that sort of pre-global financial crisis and post-global financial crisis. Pre-global financial crisis, we were probably caught up in the heady days. And we committed capital sometimes without doing the right amount of work. By the way, we made that error globally, not just in India. Those were exciting times in private equity. So our track record when we did that kind of co-investment really did not do all that well for us. And so we've changed our model a bit for post-global financial crisis. And that is much more about partner selection and trying to find partners that hopefully have access to proprietary deal flows and that are not simply going to operate in auctions and put the right amount of leverage on those opportunities. And in India, obviously, that's a little more challenging than in some other markets. All that to say, when your record is almost 20% in developed markets and emerging markets, we would look for our exposures in India to do nothing but augment those returns. So I'm kind of skirting the issue, but yes, our analysis is obviously we will have to find risk premia return that honors the incremental risk and the smaller ticket size that we'll need from India. So I know I didn't answer that directly, but I think I gave you a sense.
No. Thanks, Jane. Now moving on to the other side of the panel, Brooks, on the performance of private equity in the emerging markets, there are more than 50 investments that have been done by OPIC. So you would have a good idea as to how generally those investments have been performing So in the context of the overall question that we have out here as to what is the report card for Indian PE, how would you assess our performance and its performance as of now?
Okay, so very interesting question, and you know it's interesting because in 2007-8 there was a huge buzz for India, and capital flowed in huge amounts, and then it all went to China, and then the year after that it went to Brazil, and then capital moved to Turkey, and then to Southeast Asia, and now the herd mentality is in Africa. And it's amazing to me how private equity investors, who are supposed to be long-term investors, move so quickly with these trends. And so when you turn to performance in India, it is the case that large amounts of capital came in at the top. Now I think the best answer to the question of how India has performed is that it's too early to answer the question, because these are 10-year funds, and you still have a couple more years to make the returns. But the real answer, which is the ones that LPs feel, is that performance has not been good. But there's lots of reasons for that, including the LP herd mentality that flocked in. I think India is. I love coming to India because it's a country of optimists, and that's a wonderful thing. But you price for that as well, and that's a challenge from the private equity perspective. I think one of the earlier panelists mentioned, the entry price is just. There's a phrase that I like, which is, "Well bought is half sold." There are 2 points at which you make your money: going in and coming out. If you go in well, you're halfway there. And the problem is that in 2007, 8, even 9, a lot of managers started out sort of behind the ball with a high price. So, I think from OPIC's perspective, OPIC is the U.S. Development Finance Bank, we are structurally counter-cyclical. Our mission is to go where private capital is less likely to go. We are supposed to catalyze investment into markets that are underserved by the private equity market. So our experience doesn't necessarily mirror what most LPs felt. On the other hand, now as an investor in India, and we are active in India, we have 7 funds we've committed to at the board level to India. We are bullish, of course, and have expectations, but there is a story to be told about how much has been learned in the past 6 or 7 years, and those lessons have to be learned in order for the story to get better from here.
I think I'll like to probe this in one aspect. And you mentioned that you have 7 managers, so I'm sure their investment styles are varying across from good deal pickers, good value adders, or good trend assessors. So without kind of trying to put down one over the other, in general, I would say that what do you think, in your experience, seems to be working better? Are the deal pickers doing better, or the value add intensive houses do better, or the people who get the trend right, the vintage right, they seem to do better?
Yeah, so I think there are some GPs, I suppose, that pride themselves on being expert, illiquid stock pickers. And that has to do with trends and the macro story. That's not really our focus. Our view is much more, again, we have We have three missions as a development finance bank for the United States. We are supporting development. We are catalyzing U.S. investor interest into the markets that we operate in. We're in 102 countries. And we also make money ourselves, of course. We're a profitable bank. So in terms of what serves our interests best are managers that can add a lot of value. They're not just illiquid stock pickers. Managers who can attract, either in the fund that we're in or in the subsequent fund, institutional capital. And in many regards, that's as much a function of track record as it is a function of just institutional processes, et cetera. If you have the discipline to run an investment process, to run an origination process, to run a value creation during your hold period and to exit at the right time, if you have those processes in place, advisory councils, the ecosystem around that to do predictable, reliable, consistent, replicable investing, that's what we like, because that's what we think will help you raise Fund 2 and Fund 3. And our best success stories, an example from Africa perhaps is Helios. We were in Fund 1. Fund 2 was $900 million. Fund 3 is 1.1. There's no more role for us, but as one of the original investors in that fund, that's exactly the kind of return we want to see and development we want to see.
Thanks, Brooks. Jaganath, being a bottoms-up asset allocator, investing across vintages, and also a person who has invested before, the institution has invested before the crisis, so seen the benefits of the returns till 2008, and then seen what despair we had in terms of fundraising in India. How do you assess, from your position, the performance of Indian private equity?
Yeah, thanks for that, Akhil. So yeah, I think you're absolutely right in terms of, I think we have, Harbourvest has had the luxury of kind of looking at certainly developing Asia and India in particular for slightly longer horizons. We had been looking at Asia since the early 1990s. We started looking at India way back in 95. So I think we've seen these cycles for a slightly longer period of time. I think in a nutshell, if we look at how India PE has kind of performed both in terms of returns as well as I think distributions coming out, for a very small sliver, I think it's made money, right? I would not generically, I think typically people tend to make the generic comment that I think India PE does not make money. I think that's not true. I think a small section has done it, and I think there's specific reasons which I can go into detail later, but I think a small section has done it. I think for a fair chunk it's been very challenging, but maybe some of those returns will kind of come out. But I think a majority of it has been fairly kind of disappointing, right? So looking at either the return profile or the distribution profile. I think one other element we've seen that if you compare it to a lot of the other markets in Asia, India PE tends to be more highly correlated to the macro than actually, in fact, in other markets. So even though you'll hear stories about how PE is about the micro and not the macro, unfortunately in India, I think the macro does impact returns much more than what we've seen in other markets. Which is why if you lay out vintage returns across India PE, and we run a lot of primary number kind of crunching just to look at what the data says. And if you take out real estate and infrastructure out of it, and you look at the gross MOICs which India traditional PE has delivered, between 2003 to 2007, the aggregate gross MOIC has tracked anywhere between 2.2 to 2.4. That came down drastically post 2007 to about 1.2 to 1.3. So there is a drastic dip in terms of aggregate TV by TCs, and this I'm talking about is bottom-up deal returns kind of coming through the system. So I think in some pockets and some vintages it's done well, which basically means that there is cyclicality, and as long as you can time the cycle right, I think there's a high probability that you will make kind of returns, and which is why I think the way we are thinking about this is, India has not done well. There is a cyclical issue to that. there is a strategy, and I think there's a GP sophistication issue to that. But I think going forward, we do believe that maybe the cycle going forward is going to look different. And I think some specific pockets of India PE might kind of make sense, that there's a thesis around it, which I can talk in more detail later.
So essentially, if you were rating us on A, B, C, and D, where would we be? Because you have some very specific numbers that you just now quoted.
Yeah, so I'm hoping, you're thinking of A at, the typical absolute returns which somebody like us would track is anywhere between 2.5 to 3 times the money, given, the return expectations or net return expectations that our own LPs have. If I keep A there, I would say right now India at an aggregate basis is tracking at anywhere between B minus to C. I think we need to get that to at least B at an aggregate level for people to start saying, hey, I think this makes sense. Maybe some pockets will be in the A category, and I think people will start looking at it. But unfortunately, I think it's not there yet.
Okay. So, well, as a GP, if I ignore the C and move to Manish as a fellow GP, B minus, not too great. How do you think, or what should we do as an industry to really improve that?
I would actually agree with Jaganath and say it is a C, and I think we need to face reality as an industry that we are a C, and I hope my role wasn't to justify all that the Indian PE and GPs have done in the last 10 years, because I think we're all at fault. I don't blame any individual person. It was a bit to what Jane started off saying. There was a bit of an excessive capital around the globe in the 07-08 period, 06-07-08 period, and Jaganath's exactly right, that the multiples dropped dramatically from the 03-06 to the 07-08-09 funds. And I think there were 3 big issues, right? The biggest one, and I think Brooks mentioned this a bunch of times, was no matter how much value you try to add, if you come in at an unreasonable valuation, you will have an unreasonable exit and return. And I think we all forgot that in the hype in the 06-07, and we all overpaid for the companies that we invested behind, and we were taken in by the times. Having learned from that, I think that's one message for all the managers around the room, is be very disciplined on our entry valuation. It's a bottom-up game at the end of the day. I think the second, again, has been said, it's a rising tide sort of raises all boats. And I think all of us, and if you look at the statistics by Jaganath, we played the beta in India. As the markets rose, the PE was a proxy. We had relatively high returns in the early stages, including all the firms we represent around the room who were active in the 03-07 period. Stupendous returns. I think if people started believing it was their value add, they're mistaken. So I often quote the example where we as Temasek could do both public and private. We spent 4 times the effort in a certain investment in a private equity situation, and we made no effort in a public market situation. I'm shooting myself in the foot here, but I think it's the real, I want to identify this example. We had a 4x on the public market situation. We scraped by a 2.5x on the private equity situation, despite all the efforts we put in, right? So it was again beta, and we've got to be careful going forward as an industry. Where are we adding value? If we're just playing beta, LP shouldn't be investing behind us with our fee structure. They should be bringing the public markets. So we really need to see from the sourcing, from the value add, from the exits, on where is the value that we're adding, such that the alpha we create is at least a premium well enough, the negatives in terms of the charges we have as an industry. So that's point number 2 in terms of alpha versus beta. The final one, frankly, this is one of the reasons why Nishant, Sunish, and I set up Kedaara, was a frustration around the fact around exits. Even in those few situations where you had come in at a reasonable valuation, where you added value, if you were stuck with a 4, 5, 6% stake like most of us were, you were really left to the mercy of the promoter to drive your exits. There was actually no exit in many situations, even if the returns you had in rupee terms, and even if the dollar, which had gone extremely volatile, had given a return, you were still stuck without an exit. So our focus today is, as we do both growth investments and some control investments, is not to do control investments because we love rolling up our sleeves and being at the factory level and having fancy operating partners. That's an absolute need for us to control the destiny of our exits. So we're very exit focused on the very entry itself to ensure that we have complete, what I would call a true partnership model with the Indian promoters and Indian family-owned businesses, which frankly, no matter how much we complain about as GPs, we've got to recognize the reason we exist is because of some extremely high-quality entrepreneurs in India. And while they're extremely hardworking, extremely smart, they're also equally sharp as we are on a deal structuring perspective. So if you try to do a one-upmanship and derive value from a deal structure with a promoter, you're bound to fail because they're going to be smarter than you and with many more resources. So we've actually focused on ways in which we can do control transactions in which we're in complete alignment and in partnership with the guys who actually allow us to exist. So I think those are our three learnings. I actually think as we go forward, we were talking earlier that the pendulum, India was never as bad as people made it out to be in 12, 13, which is probably the worst time in the world for us to raise our fund. And we were told we were crazy doing it. And it's also definitely not as good as people make it out to be today with the new government. At least it's not as good as valuations indicate, because I think the public market valuations have taken a discounted value of all of Modi, Jaitley, and Jayant's positive changes over the next 10 years and put them into the market price.
Trust Manish to be the bull in the china shop. His surname these days is very, very, in India, certainly it means a lot, it carries a lot of weight. So coming back onto from your comments, essentially what we are stating in summary is a return in US dollars net, definitely 20% plus, justifying the premium that is there in the Indian market. Definitely executing a strategy which the LPs would be convinced is unique and repeatable, so that and of course attracting not only a few investors, but at least getting more marquee names kind of endorsing the details of the performance. Of course, we can always argue whether value adding or getting in the sector at the right point of time, calling the sectors right, what could work, and being in the market, all of us, for a considerable period of time, we have seen all kinds of things work in India, and hopefully, if the macro continues to be favoring and the government being pro-business, hopefully, what I see. And I see is a considerable improvement in performance. Certainly an improvement, no more C's, maybe a B plus, even A minus. Up to that, I think we should be able to get there. But moving on, and I think I have kind of set the expectations onto the next question as to what really excites our LPs when they invest in India, and what drives them to despair? And if I can ask you, Jane, that question, and see.
Sure. I'll probably focus more because, to somebody's earlier comment, India is a very optimistic country. So I'm going to talk more about what excites as opposed to what depresses or terrifies us about the market. Touched on it a little bit earlier, and that is that when we think about the GDP of India, it is one which is definitely outperforming developed markets today. When we think about the age of the working population of India, it's quite young relative to developed markets, so that's very intriguing for us also. We have what we call in Ontario teachers the growing of the aspiring middle class, which we think will drive thematics on consumerism and urbanization, against which there should be opportunities, whether it's on the consumer or retail, some of the industrial sides of the markets, education, healthcare, all these different elements that should have opportunities for increased consumption and growth within this market. So we're positive on all of those metrics. We think it's a country where there is continuing and growing opportunity for disciplined capital to earn returns over the next couple of decades, with all those major themes moving in the right direction there. These are early days, I think, for folks to have capital at work in India. What will take time, when we think about private investments relative to public investments, the reason folks enjoy investing in the more private space is you are able to do things within companies that do not have to go through the 90-day reporting cycle in public markets. And so that allows you the luxury of putting building blocks in place where the market doesn't have to see the returns 90 days later. So you can slowly create value. You can slowly shift the directions of companies and not face that ongoing tight scrutiny. You can also, in some circumstances, use what we call other people's money through leverage to help augment your returns also. So for all those elements, it is an asset class within Ontario Teachers that we absolutely are committed to. We have been for over 20 years and will be, I'm confident, for the next 20 years. And India is very much, part of that future family tree for us as we think about the next couple of decades. We'll want to see, obviously, where we can have confidence in the legal systems, confidence in the regulatory systems. We'll want to see bureaucracy transition to be less cumbersome than today. We'll want to see the credit markets continue to grow in sophistication and the ability to deploy capital here. But we think thematically, GDP, consumerism, the rising population, the working force, the growth for healthcare and education, all moving in the right direction for India. So that's the optimistic side. I'll let somebody else talk about what terrifies them.
Thank you. So if I can summarize for my own benefit, discipline in executing a strategy, whether it is focused on growth sectors, consumer demand related, aspiration related, or executing those strategies where leverage can be used to generate alpha over and above what is already defined in a competitive market. I think thanks for those pointers. Now, Brooks, once more, coming to the width of your portfolio, and my apologies if I keep picking on that. So you would have seen that venture capital, buyout, pure growth investment, turnarounds, different pockets or different styles of execution of strategy across this portfolio. And I know all of it is not in India, but what do you think from your perspective would be a good strategy to follow in terms of performance and success that you have seen for funds?
Okay, so let's see. We typically don't do venture capital, although it's highly developmental. It's not a good fit for our product. I would agree very much with the comments earlier that control is an advantage in emerging markets. Of course, every GP here will make the case that, look, their long-term capital, they are interested in helping a company grow, but all that's true, but you should still walk in the room looking for the exit. That's important. If you don't know how you're going to get out, you really shouldn't go in. So if you can achieve that with minority shareholdings in growth, which certainly is possible, then that's fine, but control positions make sense. For OPIC, buyouts, and generally anything in which we're buying secondary shares versus primary shares, is just not a good fit for us. So I'd hesitate to comment on those strategies for the for other investors in the market. What I would say, maybe to your previous question, to take some of the bearish sides of what we could improve in India for investors, and I'm speaking about foreign investors coming in, I'd point to three things. One is it would be wonderful to see more local LPs in local funds. I can't emphasize how strong a signal that is for foreign investors. There are a lot of investors who, when they see a deal coming out of Turkey or India or something, their first question is, why isn't it getting funded at home? Aren't there people who are, smart enough to recognize a good deal and fund that at home? And when that deal comes out of India or any other emerging market to be offered only to foreign investors and there aren't local investors sitting alongside them, a flag goes up. So that would be one thing that would be, I think, great for the industry overall, is to have more local LPs. The second thing I would point out is risk is real and perceived, and for foreign investors you have to address both. That first point helps address the second point, but as OPIC, we're a lender as well as there's three programs. We have political risk insurance, we do structured finance, and we do funds. For our lending operation, we have a problem in India because of a regulation called SARFAESI, which makes it makes it difficult for us to secure our loans on the same terms as a local bank. We've invested $750 million. Currently we have $750 million invested in India. As you may know, President Obama was here just 3 weeks ago. We'd like to invest another $1 billion, but issues like SARFAESI are the things that need to be addressed in order for us to really ramp up investment further than where we are now. And then the third point I would make is that on a previous panel there was the obvious observation made that return on capital, capital efficiency, and capital light investments are very attractive, and I get it, I agree. But let's not forget that there's an infrastructure demand in India as well, and that is going to be lower returns. We understand that too. But in order for the capital to flow for those investments, we really need to address some of the risk issues so that the lower risk capital can come in and fund a lot of the infrastructure needs that are here in the country.
Thanks, Brooks. Jaganath, anything you would like to add?
Yeah, if I may kind of address that question more from a kind of a bottom-up, type approach perspective, given how we kind of think about it. I think the way we look at this, and if you look at, what we believe are the 5 drivers for returns in PE, I think only 3 of them are really kind of relevant for India PE. I think the first one is what we call as information arbitrage. So you fundamentally know something that the other doesn't. Second being structural arbitrage, you can essentially structure it better than somebody else. And third being, just capital arbitrage, because I think in several cases we've seen that access to capital drives value more than anything else. And I've left out the 2 other obvious ones, which are growth arbitrage, because frankly, I think everyone in India knows where the growth is at. I think the data is visible to everyone. And the last, which is, debt arbitrage. Frankly, debt arbitrage doesn't exist in India. So I've taken those out. And if you look at the overall chain for India PE, I think there are specific slivers of strategies which we think leverage these 3 main, return drivers, and I think are in a great position to leverage that kind of going forward. The first one, if you look at, venture is positioned extremely well because I think you fundamentally have information arbitrage there. I think a lot of venture capital managers are being able to identify new trends and new themes. I think so they know something which the others don't. And then you also have capital arbitrage because in a lot of these early stage businesses, I think access to capital builds scalability. Right? And I think that's where I think one sliver or one section of India PE potentially could do well. I think we're very excited about that. I think the second sliver goes back to what Manish was talking about, which is I think on the control side. And the buy and build side, I think it partly is information arbitrage, partly is structural arbitrage. But the ability to control your destiny and frankly the ability to build assets at very close to intrinsic value, I think is going to be a very powerful lever to kind of generate value going forward. And the last section I think we are getting very excited about is also structured credit, because I think it just leverages structural capability, high downside protection, protected kind of IRRs, some equity upside sharing. So I think you can create a structure which gives you, downside protected IRRs, but also kind of upside kind of going forward. I think those are some segments that I think we think going forward we are very excited about. I think the challenge on all of this stuff is to be able to identify the GPs with the right discipline, with the right sophistication, to be able to access these in the right manner. I think the big challenge for us is just, going back to that whole discipline point, just having the entry discipline, having the liquidity generating discipline, and just, how you're kind of managing the operations, and even to some extent fundraising discipline in terms of, fund sizes, etc. I think that is very critical. And as long as the GP can get that right and can leverage, I think, some of these areas, I think there is money to be made in India.
Thanks a lot, Jaganath. Great response from you both. Since I think this will be the last question that I'll have before I open it up to the panel. So, as we were talking in the pre-panel presentation, Manish, at that point of time, you had made a very interesting point, and I kind of paraphrase a little bit on that. India is a highly intermediated market. We all know that each deal possibly has 3 investment banks which are running it at the same point of time, all on an exclusive basis. So in such a market where information asymmetry gets reduced because of presence of credible intermediaries, do you think in the long run the GPs would themselves get disintermediated in this market as more and more funds try and access India directly as opposed to through Indian GPs?
Let me just get to that answer with just a quick synopsis on what I think is exciting, not exciting for a GP versus an LP, and I think that'll lead to the answer that you're looking for. I think we've heard a lot about the demographic dividend in India. We haven't talked about the oil dividend. The whole recent drop in oil prices has caused the country to fundamentally re-rate itself from a budget and a current account deficit. So I think that aspect is common to both LPs and GPs in terms of being very attractive. And the worry that I would have is, should the oil price reverse itself, what does that mean for the macro? That's the worry. The 3 things which I think are much more unique to the GP, which the final one will lead to yours, is one, actually what we haven't talked about is the environment for us as GPs has improved tremendously from 06-07. There's far less competition. The subsidiaries of the large global banks, the merchant banks, have stopped operating or deploying capital. And there's a lot more collaboration with the fewer number of players out there, whether it's the 5 or 6 guys. I think the 2 other things which are really critical for us as we built out Kedaara was, one, given that pessimism and negativism, what's the worst time to raise a fund is actually the best time to raise a team. So the team you can actually pull together the last 2 or 3 years was actually fascinating. What we found, what we were able to attract and continue to be able to attract was absolutely outstanding. The last one is actually what will answer your question, which is about the uncanny ability of the Indian entrepreneur and promoter to create value. And I think it is the access and understanding of this 4th point, the unique circumstances, which actually makes me believe that if you have a differentiation in sourcing, then you will never be disintermediated by the competition or the pension funds. And I don't like the word as much because I think it's actually adding value across the value chain. But I think finding and aligning oneself with the promoter in India is extremely exciting, but at the same time extremely challenging. And you get something wrong with that equation, your history in terms of exits. So for us, what is the defining factor here is actually access those promoters, entrepreneurs, or different family-owned conglomerates where it's not capital you're actually solving for, it's a solution. It could be a succession issue, it could be a diversification issue, it could be an area around increased focus on the core business. And you've got to almost pick that up with the family before the family realizes it to preempt the investment bankers. I mean, listen, it's not preempting, it's working with investment bankers often, But I think unless you understand that aspect and you're local and have those relationships, you can never be disintermediated.
Well, great. That's been a fantastic panel discussion. And thank you, all of you, for participating and freely sharing your views. I know there are a few questions that we couldn't take for lack of time. You feel free to address it to the respective participants after this panel. Thank you.